Hey folks, Dan Frio here with your opening bell for April 11th, 2025. So this morning my alarm went off, the PPI number came out, the producer price index came out, and it was negative. And I'm like, okay, the markets are finally going to recover off a lot of the information that they've been getting. So I log in and what do I see? I see the stock market down 300. I see the bond market getting clobbered. But then I'm like, okay, you go over to the economic calendar and we have PPI, producer inflation, actually went negative. Yesterday we had consumer inflation, one part went negative. So what is the economy and the markets afraid about? That's what we're going to talk about in today's video. So my name is Dan Frio. I actually do this video 2 times a day to inform you guys what's going on with these things. We talk real estate mostly because I'm actually a federal loan officer. Love to be able to help you. I'm licensed in all 50 states as well as Puerto Rico. My slogan here is one application, one credit pool. We're going to shop your loan to over 30 different lenders. How do we do that? I'll give you all my information at the end of this video. So here's what happened today. Well, yesterday we had some inflationary numbers on the consumer side come in, and they were fantastic, but the market just went in turmoil. Today, when I woke up, here's the news that we got. The biggest news that we had was PPI. The producer inflation numbers came out. Let's bring up this screen a little bit right through here. So let me get my head out of the way so you can see the whole screen. So here's what we got today. We got core PPI month over month, and then we had PPI. This is producer inflation. Let's see if they give us the yearly. They didn't, for some reason, they don't give us the yearly. But let's look at this. Well, yesterday we had consumer inflation. That's the CPI on the report. So we had CPI through here. Let's go over year over year. CPI was 2.8 previously. It dropped all the way down to 2.4. Look at month over month. It went from 0.2 to a negative. Okay, so I thought yesterday morning, I'm like, this is absolutely fantastic news when it comes to inflation. Well, that didn't come to fruition. So I'm thinking, okay, well, let's get over to the next day. If producer inflation now is getting cut, well, that's only going to help on the consumer side. Well, here's what you have on the producer inflation. Month over month, it went from 0.1 to a negative 0.4. So the first thing I'm thinking is, well, the markets are going to love this information because producer inflation is going down, went negative, and consumer inflation is going down. Well, it's that ugly tariff stuff that people just don't know. So mainstream media, I even watch CNBC and all these financial channels most of the day, and that's my kind of passion at night, just to figure out what the markets are doing, and it's all tariff, 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 tariff. And if you really focus in on it, nobody really knows what's going to go on. And everybody's like, well, it's going to be short term. I think it's going to be a short-term blip. So if you're out there, you're looking to buy that first house, keep looking. Okay, if you're looking to refinance, maybe put in your application because it could be like that where the market just turns and rates plummet once again. So be ready for it this time because a lot of people missed out in September and they missed out once again in this market. So that's what we're looking at in today's market. If we go over to here, there's really not a lot of economic news. Mostly the markets were waiting for the inflation numbers. But here's what you're starting to see. You're starting to see Jamie Dimon come in and saying that, a lot of earnings reports are now going to be affected because of this. You had BlackRock saying we were very close to recession. Are we maybe now into one? So this is now the buzzword. But if you look at the numbers behind the scenes, and I had it up here a little bit ago, if you look at the economy, the inflation right now is plummeting, other than tariffs and the unknown of tariffs. You have energy prices that are plummeting as well. They're down 20% from the beginning of the year. So you have all those dynamics working for you. What don't we have working for us? The unknown of tariffs and the uncertainty all over the country. So I'm going to really dig in on tariffs this weekend and come back to you guys and try to give you an idea how much will tariffs actually add to the inflation front. Is there a possible way to determine that? If there is, I'm going to come back with you guys on Monday and try to explain that. Then you had Kashkarian. He just spoke actually at CNBC. If you want to look at this, he's a Federal Reserve official currently sitting on the Fed right now. He just made some comments on CNBC. Let's get over to see what he has to say, and then we're going to kind of take a little bit of a deeper dive into the stock market, the bond market, and what I expect short-term, mid-term, and long-term with interest rates. So let's get over to this and see what one of the Fed officials has to say of what his thoughts are on the markets.
Let's talk about things that we never really want to talk about, which is this idea of what's happening in the financial plumbing. And those are the calls that I make to people to say, hey, how is this stuff happening? And when I say financial plumbing, what I mean is the reason why you can have your paycheck direct deposited and then withdraw cash at the ATM machine, the pipes that connect those two, that's the financial plumbing. And it's all around the globe for the dollar. I made some calls to people, Neil, and one guy said to me, We're not the story now, but we're getting closer. So give us your idea or your sense at all what's happening inside the financial plumbing. Does this rate in a way that was near or close to what happened in the pandemic, or are we still far away from that and we shouldn't be worried about that?
I think we're quite a ways away from that. I mean, during the pandemic was so unique because the virus was so unknown and how dangerous it was so unknown that people fled all sorts of assets, stocks, bonds, everything, corporate bonds, treasuries, and they just wanted cold, hard cash. And that's where the Fed had to step in a very profound way to flood the system with liquidity. Ultimately, we have the ability to manage some of these transitions. So if there's a dislocation, I'm not forecasting this, but if there were a dislocation, we have the ability to smooth out that dislocation. But going back to the discussion on yields, we're not going to be able to change where yields ultimately settle. All we can do is make that transition path a little less rocky. But the settling of where yields end up settling, that depends on trade policy and fiscal policy and U.S. economic competitiveness.
You don't want to
That's
stop
out of the Fed's hands.
You don't want to stop the market from getting to a new equilibrium that it wants to be at. You can only smooth the transition there.
Correct. We don't have the ability to stop it settling and wherever it wants to settle. All we can do is smooth the transition if there are big dislocations in markets. But I'm not seeing big dislocations yet. I'm seeing some stresses, but markets seem to be adjusting okay so far.
Neil, I didn't like either scenario for why what was happening was happening. One, inflationary expectations are going back up, or two, we're becoming less attractive as the place to invest. Both sound. I can't even pick. That's like a Sophie's choice. Given the number we saw yesterday, you think that was an outlier, the CPI number, or does that make it even more troubling that there probably isn't a reason to ratchet up inflationary expectations? So then the only answer would be that we're less attractive as a place to attract capital, which I don't think we want that. I don't think the Trump administration, at least if it was explained that way, I don't think they'd want it either.
Well, when we dug into the CPI data, there was a lot of good news under the hood. One of the biggest drivers of the high inflation of the past couple of years has been housing. We've done a lot of analysis that said as new leases turned over, the housing inflation ought to be coming down. That trend seems to be continuing as we expected based on the new lease data. So I think the fundamentals of...
Okay, I'm going to stop it there because housing is 40% of the consumer inflation numbers that they report. Okay, energy is a big piece of that too. So if you go over to oil, let's see if we can find oil right here. And this is why I follow oil every day as well. If you go to oil, let's see if it's up here. I can pull probably the chart right through here. Oil is down to $59 a barrel. If you look at this, look at the trend of this thing. So again, the reason why we look at this is a huge piece of our economy, the inflation piece. If you go, let's just go 1 year. Here's where oil was a year ago, $85 a barrel, $85. Now we're at $59. It's a massive drop in the price of oil. So this is coming out of, hopefully at the gas pump, gas prices should be in the $2 range. With $59 barrel of oil, the gas should be considerably lower than where it is now, especially diesel. So when all this hopefully comes to fruition, a lot of these numbers are going to come down. This might be fantastic news long run. So let me give you my short term, my midterm, and my long run on all these. The short term is going to be a mess, folks. The next probably month or two or thray, find your pockets. If you're looking to buy that first house, I don't see rates skyrocketing. They're going to hit 7% again. I called it and I said I didn't expect it to hit again. I didn't expect all these tariffs to take effect as well to the magnitude that they are. So I missed it. But that happens. And I'll take full responsibility of it. I don't think a lot of analysts saw this coming. So you have to be prepared for when that time comes, because it could happen on a dime where rates come plummeting down. So if the rates go up and you put your application in, okay, we just hold off and we hold on to it from there. But that's where basically, here's what we're looking at. So in the grand scheme of things, the markets are looking pretty darn good. We got to get through this short term. So short term, volatile as all get out. Midterm, as soon as we get out of these tariff wars, hopefully 30 to 60 days, the smooth heads prevail and things start to really settle down. But look at it. If we have inflation now basically in the line of where the Federal Reserve is, You get through all these tariffs and things settle within the next couple months, and you're getting also money from these tariffs that's helping our national deficit. 6 months, we should be fantastic. In a year from now, where things going to be? So I'm going to give you my midterm. My midterm it's going to be right around 7% in rates. That's my short term. My midterm rates, I'm looking as a spread between 6.75 and 7. And my long term outlook is I'm looking at by the end of the year, we might be at 6.25 to 6.5. Do you wait? I could be completely wrong, folks. So if you're out there at 7.75, rates like that, and you're looking to refinance, check with us and see if there's a savings there. If you're looking to buy, let's make sure you can budget. You have the amount of money for the down payment and the whole transaction, and we can make sure we're putting you in the right program to do just that. So let's go over and talk about what I do and how I do things. Well, my name is Dan Frio. Our slogan here is we take one application, one credit pool. We're going to shop your loan over 30 different lenders. Here's the cool thing is I'm licensed in all 50 states as well as Puerto Rico. There's no reason why you can't use me. But the next thing is, Dan, do you have the programs and the rates we need? Well, here's how we work. I'm set up at a federal bank, and that's where I work. We also have 33 other lenders right now that we've partnered with. So I can offer you their rates, their programs, everything about them, and you'll use one application and one credit pool. How do you do this? Go to therateupdate.com. Here's my website. Right over my head is where you can put in your application. You can also schedule a consultation right through here. Give us a call over here. But if you want, I put in 2 fantastic videos, and I'm going to be shuffling these around monthly. Right now, we have Home Buying 101. If you want to really figure out, how do you monitor your credit all the way to the application and keys in your pocket, I can navigate that right through here. If you're a homeowner right now, fantastic tool for you not to miss any of these refinance opportunities. So you go to the RateWatch. So if you're a current homeowner, you're going to click this and you're going to put in your mortgage information. We're not selling the data. I'm just putting it into a database that we have here. And when that rate hits exactly where you want it to be for a refinance, get you on the phone and we'll get the paperwork started. So thanks for watching, folks. I greatly appreciate you watching. Hopefully you learned something. If you could do me one favor, I'm trying to hit 50,000 subscribers today or this week or this year. And the only other way to do it is for you guys to help me out. So if you could click over there, the subscribe button, I'd greatly appreciate it. Thanks for watching. I'll be back at the closing bell to let you know how all this mess ends for the day. Thanks for watching, folks. See you then. Bye-bye.